Hello and welcome to CIMA F1 Financial Operations Chapter 11, Group Financial Statements. This chapter is about consolidation, and I'll take you straight to a diagram you have on page 48, and it's about consolidation. To discuss about consolidated financial statements, you need what we call a group company, and we'll refer to parts of this group as parent company, the company that is initially set up, and then the subsidiary company, the company that is set up by the parent company subsequently. Now for CIMA F1 level, the group structure will be when parent has 100% ownership of the shares of the subsidiary. And as you can imagine, anything in terms of ownership more than 50% gives you, in simple terms, control. So control is based on ownership that is more than 50% in terms of the shares. So that's the structure we're going to look at in this chapter, and it will not be a case of having in the exam a parent company that sets up a subsidiary with 75%, because in 75% you still have control. You'd use the same rules for consolidation, but that is not examined in F1 when you have control but is less than 100%. In the exam for CIMA F1 you have this combination, control plus having 100% ownership. And that means when you have 100%, there is no what used to be called minority interest and currently is called non-controlling interest. No non-controlling interest in this paper. Next paper up, get ready for it. Okay, why do we need to talk about consolidated financial statements? If you think from investors' point of view, so put yourself in the shoes of this individual here, they set up this parent company, and they will see the assets and liabilities they control in the parent company. Later on in time, the parent company sets up a subsidiary, maybe even cross-border, that has control 100%. These investors are responsible, interested, and can control the subsidiary. So they would like to know not just what this parent is doing, not just what the subsidiary is doing, but how are they doing together, consolidated. So in order to avoid or to reduce, to mitigate the information gap that existed before we were consolidating, financial reporting considered and issued standards in respect of putting together the assets and liabilities of all companies controlled, and of course the profits. And there are certain rules. You put all these together, obviously, on statement of financial position and statement of comprehensive income. Now, what I would like you to know as a big picture, there are some standard consolidation workings that you will need to know, both for a statement of financial position and statement of comprehensive income. So you will have goodwill will be one of the working. A second important working is consolidated retained earnings. And it is not examinable, but a classic one would be non-controlling interest working as well. Now, so remember, NCI calculation, you will see it in F2, but this is not applicable for this level. So let's have a quick look of how is it in goodwill and consolidated retained earnings. So if I'm taking goodwill, I'm going to take a simple calculation. What you have to consider is what is the cost of investment. In other words, how much we are paying for this subsidiary, let's say. How much? So you have a figure, X, less, remember, fair value, that's very important, fair value of net assets acquired. In other words, how much is the net assets of the subsidiary. And here we look at date of acquisition. How much are they? Well, that's another figure. And how much have I acquired of that? In our case for F1, 100%. So is the value of the fair value of net assets acquired, which will take you to goodwill. Where do you see goodwill? In statement of financial position. Remember, goodwill is not amortized, and you are going to test it periodically for impairment annually, and that impairment loss will be given in the exam. So you are given an impairment loss, and then you are getting the goodwill you're taking in statement of financial position. Remember, if goodwill is negative, you're taking it as a credit to statement of comprehensive income. If it's positive, you're taking it to statement of financial position. So this is your goodwill calculation. Further on in your notes, I'm skipping a little bit through, we were mentioning about this fair value issue. So remember, the net assets here in the goodwill have to be calculated at fair value. Now, if your net assets acquired in the statement of financial position of subsidiary were not held at fair value, you must have a revaluation done to get their fair value at date of acquisition. Remember, goodwill is always a date of acquisition. So once you get that revaluation for fair value, imagine that fair value may be amortized or depreciated, maybe, let's say, depreciated, assuming it comes from some non-current asset. So where will you see the depreciation charge per annum? That will be a minus in the consolidated retained earnings. All right, so we dealt with one key working. Well done. Hopefully it's all fairly clear. And let's have a quick look at other type of adjustments and consolidated retained earnings. So I will just mention consolidated retained earnings as well. The simple rule, consolidated retained earnings. Remember, you're going to take the profits of P, parent company, you're going to take 100% of them, and you are going to take the proportion of the profits that you acquired. In our case is 100% for F1 of the subsidiaries profits, retained earnings, but very important, only the post-acquisition component. So you'd have to calculate post-acquisition retained earnings of subsidiary less pre-acquisition retained earnings of subsidiary gives you the post-acquisition portion. And for F1, you have 100% ownership, therefore you take 100% of that, you add it to the parent 100%. And sometimes to this basic rule, you have certain adjustments. Now let me share with you very few specific adjustments you may need to understand and do. Intragroup transactions is one of them. If parent and subsidiary is transacting with each other and they have receivables, let's say for the sake of argument, and payables to each other, as at the period end, this should cancel off. So when you consolidate, you will not see receivables from your subsidiary in the parent company because you're consolidating and try to net and they will disappear in effect. So intragroup transactions, making sure you have receivables and payables intragroup disappearing. Now, there is one more single adjustment I would like to mention, and that is provision for unrealized profits. So I'm just giving you some highlights, and of course you'll have to look for reading this chapter, and the key to pass these consolidation questions is just question practice, doing your workings and applying the basic rules. So if you look at, let's say you have the parent and you have the subsidiary, and the parent make a sale to the subsidiary for the sake of example, and let's say you have a selling price of 100, but the cost of those items was 80, and therefore parent company records a profit of 20. And let's say we sold these items and 100% of these items are with S at date of consolidation. In other words, are not sold outside the group. If they are not sold outside the group, we have not, from a group perspective, earned this profit just yet. So what do we have to do from a consolidated perspective? Remember, this is not adjusting P's individual financial statements. We have to get rid and reverse that profit figure. So you have two angles to look at it. If you look from a statement of financial position, the adjustments you are making, you are reducing inventory, consolidated. So the basic rule is 100% of parent inventories plus 100% of subsidiary inventory. I'm talking just less. So you are adjusting less what we call this 20 provision for unrealized profit. So that's how it's going to look. You take inventory of parent, inventory of subsidiary 100% and take out the provision for unrealized profit, the 20. What happens in statement of comprehensive income? Well, you are just reversing the transaction. So you're saying debit group revenue, credit group purchases. You're doing two steps. For 100, like it never happens. And then you are also adjusting your cost of sales. You are adjusting the cost of sales with provision for unrealized profit. Okay, so that's the equivalent of, if you look in statement of financial position, because you need a double entry, is the retained earnings consolidated. So if you are here in statement of financial position, you reduced inventory with 20 and you reduced retained earnings consolidated with 20. Minus, and you had here minus 20. And of course this retained earnings is corresponding with the cost of sales in the statement of comprehensive income. Okay, these were a couple of highlights of this chapter. So remember your goodwill, if anything, remember your consolidated retained earnings basic rules, and remember the provision for unrealized profits we mentioned here and the intragroup balances. Have a look at the steps, because we provide various steps to deal with topics in, for instance, these sort of steps I'm referring to, which makes you more methodical in your exam. So good luck with your question preparations and good luck in the exam. All the best.